Okay, thank you, Trevor. That was really good.
Okay, thanks, guys.
So next up, we've got Dave Loescher. So we kind of, when we were putting this conference together, first I forgot to fill it. So one of the things that I've done to help you guys is I hired a PR company about 2 years ago, Pilmer PR. Rochelle helped me put all this together. And part of the reason I hired him is, as you can see, hopefully we try to do things a little bit different. And that difference hopefully makes our company more attractive to owners, or to owners and to tenants, so that your properties can get filled quicker. And I couldn't have done this all without them, and I'm grateful for them. So we kind of had a plan as we put it together and the organization of it. And so we wanted to end as we're looking with Dave Loescher. And he's another good friend of mine. As you can see, like, I've just brought in a lot of friends that I have on contact that I can call, ask questions on any, throughout, so we can learn and figure out how to work through and what's coming. So, but Dave has, hopefully you guys got out of this that, hey, there's still opportunities there. Obviously the market's changed. And obviously, as it's changed, there's got to be different products that come out of the market. And so Dave with Academy Mortgage has some of the best products in the research that I've done, and he's a solid human being. So it's a good double up there. So I'll turn this over to Dave now. Trevor, if you can stop sharing your screen. And I'll turn it over to Dave. Thanks, Trevor, to let him take over and go over everything. He's at a conference himself, but he's taking a break after present. So I'm grateful for that. So thanks, Dave.
Yeah, you bet. Can you guys hear me okay? Derek, do you hear me? I want to make sure that my...
Yep, we can hear you.
Okay, good deal. Good deal. Well, thank you very much, Derek. Thanks for that. Appreciate the opportunity to be here. And as Derek said, yes, I'm in Salt Lake City. We have our annual with Academy Mortgage, who I am a branch manager. Really quick, I'll just kind of introduce myself. I'm a branch manager with Academy Mortgage in Cedar City, Utah. And for those that don't know Academy Mortgage, we're a large mortgage bank. I say large because as far as the different mortgage banks out there, we're in 49 of 50 states. We have brick and mortar locations all across the country. And right now we're having our annual conference. It's called our Leadership Summit, and it's right here in downtown Salt Lake. So basically I just broke away from some meetings at the tail end of the day here and just was able to come and take part. And I'm grateful for this opportunity. Derek talked to me quite a while ago about doing this, and I've been excited, for the opportunity and the possibility to do this. So quickly, I guess I'll just go ahead and share my screen. Let me see if I can do this correctly. So let me click share screen, and then we go to this. I'll share that, and hopefully this will work. So I'm going to try to see if I can do the, can you guys see my screen okay? You probably see my.
Yep, we can see it.
Okay, good. I think I'm trying to go to my slideshow, but I think it must be covered up here. Hold on really quickly. Let me see if I can get that to play. Those of you that might be a little better at this than me, maybe you can chime in. How do I click the slideshow? I think it's up covered by the Zoom settings is why I can't see it. Oh, it is. It's right here. There we go. Okay. That's why it was covered by the Zoom stuff at the top. Okay. Anyway, as I said, I'm Dave Loescher with Academy Mortgage. Academy is a Utah-based company, but we're in all the different states. And we do direct Fannie Freddie stuff. We sell our products right to Fannie Freddie, as well as all the above. We can broker how some of the other mortgage lenders do it. And I wanted to talk specifically, we're going to talk about investment programs, because that's what the conference is all about. And I kind of want to talk about the history of investment financing. And it kind of follows along with the what's been happening in mortgage trends. I mean, unless you've been living under a rock, we all know that things have kind of changed over the last year. And that's the only constant. This whole thing is change. We've seen where, mortgage financing, it's like a pendulum where things get easier, simpler, where guidelines are loose, and then we can see where guidelines actually tighten up. And when things tighten up, that's where we see changes in things like products offered, advance rates, how high can we go, how small of a down payment can we offer. And when it comes to, and I'm also a property investment property owner, so I kind of can feel, I hope I'm able to talk from both standpoints here as the person that provides the financing, but I also can see what is important. I think I have a fair understanding of what's important to you as an investor. And the key to it, there's some investors out there that want to find financing where they can leverage themselves. We've seen that as a real popular thing lately. They wanted to see if we can get in for as little down payment as possible. We've seen others that are a little bit more sound that, maybe they've got an exchange they're going to do, and they're going to do the exchange. They got a significant amount they're going to roll into it, or maybe, somewhere in between. Maybe they're going to do 30% down. Who knows what it is? But anyway, those programs, there's different programs out there and they fit and they're catered to each of these investors. So I want to talk a little bit about that. But first off, as the slides here says, the only constant is just what I said earlier, is change. Investment property finance, is not exempt from this rule. We've seen it, especially over the last year. Going into this next property or this next slide here, I kind of wanted to talk about things prior to, and those of you that have been paying attention, maybe you have a couple of several investment property loans, and you've seen how things have taken a transition over the last few years. In April of 2021, things were, prior to that date, they were easier for investment financing. We had programs that were more readily available. We had interest rates that were more in line. I don't want to talk about general market rates where rates go higher and lower, but what I'm talking about is where you have a primary residence interest rate that's offered, and then you have an investment property interest rate. As all of you know, the interest rate and the offering of the terms on an investment property is higher than a primary residence. To answer the question as to why, if anybody's asking that, I assume I don't, most all of you know that, but it's basically because risk is equal to, it's the biggest thing is risk-based pricing. Investment properties are statistically the first properties that people will walk away from when they fall upon hard times. And for that reason, they're deemed more risky. And since they're more risky, their terms are going to be a little less attractive and their interest rates are going to be a little bit higher. But prior to April 1st of 2021, there was a bigger appetite in the market. And that was for mortgages that were secured by investment properties. Before we go any further, I just want to address one thing. When I talk about appetite in my presentation right now, as you all know, when it comes to mortgage financing, it's all about, we can originate loans, but we have to be able to originate loans that have an end in sight. And what I mean by that is these programs need to be able to be sold on the secondary market. You do have some boutique lenders, some small aggressive lenders that may be out there, they're more private, where they'll loan their money and they'll go ahead and hold that investment, that loan, long term. But those are very rare. We don't see that very often. The large majority of mortgage lenders out there, we loan our own money. It sits in our warehouse lines or whatever other option that we have, and then it's going to be swept off as we sell it to Fannie Mae, Freddie Mac, who are the regulators, or it's sold off to another investment bank, some sort of credit unions would play a part in that. So what happens is we have to follow certain guidelines. So that's what I mean by the appetite. And if there isn't a big appetite, if they're not wanting, those big investment houses, big banks, if they're not wanting, or even Fannie and Freddie, because they set pricing as well, if they're not hungry for investment properties right now, if they're only wanting primary residences, then it's kind of like that supply and demand thing. The demand drops. And what happens is all of a sudden, the pricing and the terms of gets worse when the demand drops. So what happened in April 1st of 2021 is, prior to that, things were good. At that point, all of a sudden, the regulators, Fannie and Freddie, and a lot of the people that were buying mortgages, they're losing their appetite for it. So simply what happened is down payments started to climb. Fannie and Freddie, they imposed new limits on lenders. No more than 7% of all new loan volume for any institution, being like Academy Mortgage. We had everybody out there was limited to where no more than 7% of all the new loan volume that you did in that time period or a year could be secured by investment properties or second homes. We didn't used to have that number. They shaved that way down. So we had to follow these guidelines where we could not exceed 7% of our total book of business. Fannie Mae also required that all investment property and second home loans must be underwritten with desktop underwriter and received an approved eligible recommendation. What that means, basically, we take a new loan and we have to run it through Fannie and Freddie's automated system, Fannie or Freddie's, I should say. And it required now that investment properties needed to have that approval designation from the regulators in order for us to be able to put it on the books. So what happened here is all of a sudden things tightened down. And that's why we saw about a year and a half, almost 2 years ago now, that's why we saw the investment financing really just tighten up. And it became a much more difficult thing. It was frustrating, almost embarrassing for us as lenders, because now we're receiving a rate sheet after April 1st of 2021, where it's like the rates we had to quote were higher. The down payment requirements went up. And it's frustrating. It's frustrating on us. And I know for you as investors, it's frustrating for you also, because where you might have been able to get more of those loans that were 10% down or even less in some cases. So you could leverage more of your cash that you had to buy more properties. That kind of became a harder thing to do. And then also, as the interest rate on the investment properties loans started going up, cash flow becomes an issue. So definitely not fun times. So what do those new restrictions do to financing of investment properties? Just like what I was just starting to mention, the criteria for the underwriting, it got tighter. It got more difficult to get people approved. The assumption is that rental properties carry more risk than primary residences, and that's why that got harder. And what did that mean for property investors? It basically meant that a conventional loan, if you went conventional on these things, that it just got more expensive and your advance rate just became less. Fannie Mae, the regulators limited their loan purchases. So fewer lenders now have an appetite to originate these loans. And I refer to Fannie Mae because Fannie Mae and Freddie Mac are typically the cheapest and the financing source for banks or mortgage banks like us to be able to sell our programs to. And when they lost the appetite, it just made it a challenge. And I'm going to make a time out here real quick. I feel bad. I don't want to just be doom and gloom here. I don't want to be negative, but I just wanted to address all this because I'm going to talk about, where we were, where we're at today, and a little bit about where we're headed, in my opinion, of course. But so I'm just kind of bringing up some of the unfortunate things that took place over the last couple of years. So please don't think I'm negative Nelly or just trying to put a bad shadow on this. But anyway, most other lenders charge higher points and ask for more money down. They don't want to fund a loan only to sell at interest rate elsewhere. And that means that lenders will now charge more for investment property and second home mortgage loans. And that's, again, what took place. Some lenders out there started adding where it was real popular prior to 2021 for us to be able to offer what's called par pricing. Par pricing is where we could give you an interest rate that was very attractive, an advance rate that was very attractive, and do it with no points, or no points, no discount. It just made your closing cost much less. Well, when all those loan level pricing adjustments from Fannie and Freddie came out in April of 21, all of a sudden lenders, we could not put a loan together unless we were charging, in some cases, 2.25 points that were added to the loan. And in some cases, it got even up to 5% in some lenders, because it got to the point where we can't do loans for free. And when the regulators put that tightened down on us, it just made us, that's the only way we could offer it. So in a nutshell, that's what was going on. And now I want to talk a little bit about, and this may have been covered a little bit previously, and I feel bad because I've only been able to jump on the call twice on a couple of breaks, so I don't know everything that was talked. I got to hear Trevor, and I've known Trevor for a long time. He's excellent at what he does, and he talked a little bit about the interest rate market and what's taken place. And so I don't know exactly what was covered, but if I'm going over something that was, I apologize. So one thing I want to talk about right now is, as the demand for rentals increase, is that financing options will emerge. And what I mean by that is, we've seen this increase in interest rates on primary residences. So I want to shift gears a little bit and talk about somebody that's wanting to buy their own personal home. Maybe it's a young couple. Maybe they just graduated from college and they've got a little bit of money saved. We all know interest rates rose and property values really didn't come down much. Well, what did that do to those folks? It took them from being people that have been waiting for the American dream of owning a home, and maybe they just can't qualify. So as you all know, and probably spoke about today, is rentals have become even more so attractive for these young couples. That's their only option, is to be able to get into a rental and rent their home. And instead, and it might not even be for short term. I've been reading some reports that talk about how some young couples may be renters, not just for a few years, but it could be for a decade or two, or permanently in some cases, just because they're kind of priced out of the market. And that's a sad thing, but for property owners that have investment properties like what most of you do, or what you have, that's a good thing. And as the demand for rentals increase, that's just going to be seen by the regulators and by other investment banks that buy rental loans or rental mortgages, that it would be more attractive, less risky. And we might start to see some of these financing options emerge. And what I mean by that are some more programs out there that are a little more aggressive. Maybe they offer a better interest rate. So hopefully that'll start to happen in the future. So lower down payment options could come out. So real quick, Fannie Mae and Freddie Mac. So if we do a regular loan that we sell to Fannie Mae and Freddie Mac, down payment minimums are typically 20% or 25% if you want the best interest rate that we can get you, is 25% down. And that's if we go that route. We do at Academy, and I don't really want to take a lot of time to just toot our horn about some of the products we have, but we do have an opportunity. We have a product that we can do 10% down on an investment property purchase, and 10% down, and it does not have mortgage insurance. So obviously that's not a loan that's sold to Fannie Mae and Freddie Mac. It's not one that's going to go through the regulators. It's going to be one that's offered from, it's going to be sold into a credit union that we participate with. And then we have other investment firms, that your JP Morgans and a lot of your larger ones, that they start to create conduits where they create programs that have these lower down payments. Some of them don't, even though they're less than 20%, you won't have to pay mortgage insurance. What does that mean for you? That's if you get your debt service down and rents rising the way they have, that means more cash flow for you as the property owner, as the investor. So one of the things that's going on. So no mortgage insurance programs are in there. Hybrid ARMs, we're starting to see that as an option. And hybrid ARMs are basically, instead of being a 30-year fixed, we're starting to see the resurrection of ARMs again, which is nice. I mean, for a long time, when interest rates were historically low, ARMs didn't make any sense. So they made very little sense, because the 30-year fixed was already so low. It's like, why do we want to put somebody in something that's a 3-year fixed and then variable after that, or a 5-year or a 7-year fixed period and variable after that, because the 30-year was already so low. Now that interest rates are rising up, hybrid ARMs are coming out. We're seeing more of that, where people can fix their term, their interest rate for a term of 3 years, 5 years, 7 years, 10 years, and we're able to offer something a little bit lower. So you just know that down the road, more than likely, you're going to have to refinance that loan when the fixed period runs out, or maybe you're going to sell it. Whatever your strategy is in your investment portfolio. And one of the things here is hopefully Fannie and Freddie, the pricing adjustments, and that's the LLPAs, the loan level pricing adjustments that they set, will reduce for less of a hit, as they start to see these things become less risky. So the question I have here is, and this slide is, does it cash flow? And again, Trevor Carlson just talked about prediction of interest rates and values and that, so I don't really need to go over that. But what does it mean, as far as cash flowing, and how does the mortgage play into that? And that's really going to helps a lot with determining what you're going to make. You start calculating cap rate and such. And I wish we could do this as an open discussion right here, but will market rates increase, to help with cash flow? I think that's $1 million question. We've certainly seen rents be on a continual increase. Maybe they've flattened a little bit lately, but I think as the demand for rental properties continues, the market rent for these properties, these income producing properties, will continue to hold steady, even though property values hopefully will soften so that you can get into them at a better price point. And that's just, will there be urgent distressed sale opportunities to help capture lowest purchase prices, to help you get into something that's lower. So anyway, going off on a tangent right here. So major consideration, and this is one thing that, and if you guys address this today, I really wish I could have listened to the whole thing, but I'm at this conference, so I couldn't. And I've been reading a lot of articles on it, is what about all the Airbnb properties that are out there that could enter the long-term rental market as the looming recessions threatens the disposable vacation income? Derek, can I ask, is that something that you guys addressed today? Is that something you guys talked about?
We haven't. The only thing that was kind of discussed along though is some potential state regulation that may be coming down the pipe. So you're going into uncharted territory. So have at it.
Okay, sorry. And this is something I've been concerned with myself. You know, I talk to people that have rentals, and like I said, I have a rental, and it's one of those situations where, you know, as we've seen, there's been limited competition. You could almost advertise, or, you know, Derek would advertise these properties and he would find renters and be able to get you top dollar. One of the things that could in the future be a consideration for us, if you're owning longer term stuff, is what about as the looming recession continues to tighten down? You know, eggs are now what, $9 a dozen, $8 a dozen? That's ridiculous. You know, gas prices are where they're at. We have some things in place right now that are it's got to start at some point putting a strain on those people that are vacationing. And when you start to see people pull out of that vacation spending, Airbnbs are going to be more vacant, if that makes any sense. So what some of these articles I've been reading, and this is something to consider, is, and I'm stepping away from the financing aspect, just talking about something to consider, is we're going to see a little bit of an influx of some of these people that have been holding Airbnb properties, these short-term rentals, and they're going to need to start looking at, they're probably going to enter and become competition. So it's something to consider there. But in my opinion, the long-term rental hold, it's not a get rich quick, but it's a win. The tax benefit is just as good as it gets when it comes to the depreciation portion of it. And as we talked about, as young buyers aren't able to qualify, it's going to continue to be the best investment, the safest thing that people could do. And I think it's obviously you want to diversify your investment portfolio, but I think everybody should look into getting into this. So I talked downstairs with the head of our secondary division, and I knew I was coming back to my room to give this presentation, and I wanted to get kind of his opinion on where things are headed. Obviously, everybody's crystal ball is broken. We don't have one that works. We can't predict exactly what's happening. And I'm not going to really talk about interest rates so much, where I see interest rates headed, because that's something you guys probably addressed already before I got here. But I asked him specifically, I said, do you see Fannie and Freddie loosening up, kind of what we talked about? Will they make it easier on the investment programs? Will they make it so that we can offer investment programs with maybe lower down payments, maybe less of adjustments? You don't have to pay 2 points, 3 points, and a high absurd interest rate on your Fannie Freddie guaranteed loans. He said that he thinks that for the short term, the answer is no. He doesn't see that being the case. But what he does see, and what we're already seeing a lot of, are what I mentioned a little bit earlier, and that's going to be these investment banks. We're seeing these real estate investment trusts. They're large scale. Like I said earlier, JP Morgan, a lot of these different investment houses where they really need to diversify their portfolios for those large investment pools that they have. And they're creating programs, they're creating mortgage programs and coming to lenders such as Academy Mortgage, and they're able to put things together that are very, very attractive. And that's kind of how we find these programs, like I mentioned earlier, where we can do, 10% down with no mortgage insurance. It does, would take a couple points, but if you can get in, now think as an investor here, if you have X amount of dollars and you'd like to maximize your investment, and that would be to maybe buy 2 properties or 3 properties with that. If you can put 10% into 3 properties, as opposed to just 30% into 1, because we have these, again, aggressive programs that these investment firms are coming out with, and not having to charge you mortgage insurance on it, that's a win. Now you just basically were able to buy 3 properties instead of just 1. If we didn't have those options that are out there now and hopefully continuing to come out, as he feels that they will on that private sector, then if we didn't have that, you'd be stuck putting 20, 25, 30% down on an investment property rather than leveraging your money to be able to get as much bang for your buck as you possibly could. So interest rates, I don't see that. I think long-term, yeah, I think a year from now, interest rates in general will be lower than they are today. And I think it's going to take Fannie and Freddie and the regulators really getting to the point where they're willing to lighten up a little bit and stop being so tight on things, that we'll see that part come back. But I just think that it's going to be the private programs, some of those aggressive arms and those lower down payment programs are going to be the ones that are going to be the best tool. So if you talk to a lender and you're looking, or the lender you work with, or I'd be happy to talk to you as well. If you have a specific property or properties you're looking to purchase, look into some of these they're called non-agency loans that aren't going to be sold to Fannie and Freddie, because you can typically get more out of your investment that way. And I think that was it that I have on my slideshow. I'm going to go ahead and stop sharing the screen right now. And Derek, we open it up for question and answers now. Is that kind of the
any questions that anyone has for Dave? Ask now. It's been hit or miss. So one of the things that, like, one of the reasons we brought Dave in is because everyone's like asking, like, what does the market hold? What can we do? And like I said, like his presentation did, hopefully now, if you're looking to expand your portfolio, which I know some of you guys are, you now have some additional options that can look at that may make it easier for you to jump in on some.
Yeah, for sure. And one of the things may be too, and if I can say this real quick, is that we may start to even see something where, and I don't want to call it stated income, but when I know we have programs right now with investment that I'm able to do, where people are able to buy investment properties, and we're doing them as just basically a cash flow loan. And maybe some of you out there have these programs. We're not getting your tax returns and going through it for the last, 3 years or 2 years or whatever. We're able to give you financing where we do a debt service coverage ratio. So it's a DSCR loan. Our main concern is that property that you're looking to purchase covers the rent that you'll be able to charge on it, will at least cover the mortgage. And if it does that, and you're putting whatever the required down payment is for that program, typically it's around 25%. We can do that where you don't have to prove your income. And now, granted, that's going to have a little bit, again, risk is equal to reward here. That would have a little bit of a higher interest rate. But if you're finding a great deal, a great buy on a property, and if you're thinking, I just don't have the tax return income right now, I haven't claimed enough, because let's face it, we all maybe sometimes want to get aggressive on our taxes. Don't let that don't be shy that way. Talk to a lender, see if they have some of these alternative income source loans so that you could get approved now rather than wait later. Because if it's a good buy, and I know when it comes to investment properties, it's all about timing. It's about location, but it's also about timing. It's finding that property that, someone's finally going to move on it. They're going to sell it, or somebody and they're offering you a deal, but you got to take advantage of it now. Don't be bashful. There could be a program that can get you to that right away. Anything else?
Okay. Well, with that, thank you, Dave. Downside of being the last one of the day, it's a long day. So I appreciate everyone that's attended. Hopefully it's been helpful to you guys. A couple things, like, we have recorded this, so we'll be sending this out to all of you guys. We're going to parse it down by presentation so we can send out a master link, and you can rewatch the presentations that you would like without having to watch all 5.5 hours. I wouldn't do that to you guys. You've done it and gone through once. So any questions for me before we close this conference out? Okay. So with that, thanks again, guys. I really appreciate it, and we'll go ahead and close it out. If you have any other questions, don't hesitate to reach out, and we really appreciate you guys. Thanks.
Thank you. Thanks, Derek.